Welcome to Markets Now. I'm Michelle Rook with Dave Chatterton, Strategic Farm Marketing. Well, the livestock futures ending mixed on Wednesday, but the grain trade after a higher opening ending lower today, Dave. And let's talk a little bit about that. Did the market just hit some chart resistance here in the grains, or did the funds kind of run out of ammunition?
Yeah, I think kind of a combination of both, Michelle. We saw the December corn contract in particular get right up against that 200-day moving average and kind of fail just a little bit. Really brought down maybe by the action in wheat. But I think what we've seen here, we had a higher opening, Michelle. We tried new, right up against those highs in the corn market as we mentioned, and didn't find any new buying. So the market, we saw some profit taking today and some pullback, a two-sided, pretty choppy trade here. And I think we may be in for some more sessions like that as we go forward here. We've got still elevated geopolitical risk in the marketplace. We're certainly watching the weather and what's happening not only here in the U.S. for planting, but also in South America, what the final crop size might be there. We're watching what's happening in the Black Sea, particularly around the Russian wheat crop. So a number of unanswered questions here. And, we've elevated ourselves to a higher trading range here of late, especially compared to where we were coming into the first of the year. But maybe taking that next step higher, I think might require a little bit more oomph behind some of these stories to kind of, elevate us to that. In the meantime, like I said, could be in for a little bit more of a choppy two-sided type trade developing here in the near term.
So what about technically? We seem to be above many key moving averages in a lot of the grain trade, including the 100-day moving average. But it looks like today we started to run up into some other chart resistance.
Yeah, like I mentioned, we hit that 200-day moving average in the corn market. That's one of the things that funds watch rather closely for a longer-term view of which way the market is pointed. We haven't been able to get through some of these key technical numbers. So $5 December corn, $12.40 November beans, much above $6 on the nearby wheat here, or excuse me, $7 on the nearby wheat. So we're working in towards some of these numbers, but we haven't been able to quite push through them yet. And in doing so, the market technically is, like I said, we're just stalling here just a shade. I wouldn't get overly concerned at the moment here. A good correction wouldn't really be the worst thing that we have, as long as it is a correction.
Are we going to need a bigger weather story to keep the funds covering shorts or maybe even pushing long in this market?
Yeah, when you look at big part of the story, Michelle, is that the funds have covered a big portion of those net shorts that they held in both, across the board, corn, beans, wheat, and even in the products. To this point. That doesn't mean they won't cover the rest. Doesn't mean they can't go long this summer. But I think you need to, the old market adage, you have to feed the bull every day. We have to keep seeing those adverse, kind of events come in. We looked, today at the midday GFS. It sure went a lot wetter here for what I'll call maybe the Eastern Plains and parts of the Central Midwest. So Missouri, Illinois, Iowa, Indiana, Michigan, all, totals there upwards of 3 to 5 inches here in the 10-day outlook. So certainly there's going to be some challenges there, but I think the market needs a little bit more definition around what that's going to mean to planting dates, what that's going to ultimately mean to yields and production. And it's an open question. It'll be debated the rest of the growing season here, but like I said, it might be in a little bit more choppy fashion than we've been used to here the last few weeks.
So wheat was the first to break out, though, on weather concerns, global weather concerns, and maybe a shrinking crop over in the Black Sea and Russian areas. Do you think that narrative is over yet? Do we still have more to come there? And was the wheat market also watching, the U.S. narrative and the wheat quality tour today?
Yeah, again, I think you're hitting it on both on fronts there. So when we look at the U.S. wheat tour, again, I mean, those results pretty good to date, but I think they could change rather dramatically as we see the tour head into the more problematic areas of Western Kansas in the next couple of days. Those numbers should probably be coming down. I think there's still a chapter or, an open question and a debate as to what the final size of that Black Sea crop is going to be. They've got a large carry-in stocks that can cushion any blows coming forward, but losing production there, when you look at the export market and what's happened in the last really 24 months, is that Russia and Ukraine have really set that bar and set that price. So that, we need to get to a point where we open the door for either U.S. or at least other world exporters to get a piece of that pie. I think that's going to take a Russian crop probably below 80 million metric tons.
Okay, and we're far from that yet. What about the soybean market? It felt like the market was kind of disappointed in that NOPA crush figure.
Yeah, for sure. I mean, the number came in, well below even the lowest trade estimate for the month. It's a 7-month low. It's 20 or 25 million below what the average trade guess was. So little bit of a shock to the system there compared to what's been a, record after record after record month. And, plants here look like they're extending their seasonal downtime a little bit, Michelle. I think that's a function of just where margins are. We've seen the oil market under pressure here as imports and blend stocks on the biofuel side have kind of brought that market down just a little bit. Year to date, the crush is still in pretty good shape. We're up about 5% for the marketing year so far. USDA calling for a full year increase of about 4% on their balance sheet. So, nothing to really push the panic button about at the moment here, but certainly we're looking for demand where we can find it in an environment where our ending stocks and our carryout appear to be going up year over year.
Dave, let's also talk about the cattle market. We did see some higher prices in the futures with the discount that we're holding to the cash, but it seems like this big surge in the product values has really started to push this market. Can we keep going?
Well, it's a really good question. We're seeing this jump in the cutout, and it's been a pretty dramatic jump here in the last 3 days here, well above the 300 mark, even through the 307 mark today on the middays, Michelle. And in doing that, I mean, we're doing it or accomplishing that via smaller kills. And cutting kills or cutting your slaughter rates at a time of year when your seasonal demand is supposed to be peaking kind of worries me just a little bit. Now, how we're getting there and the recipe of how we're getting there doesn't change where we're at. We're in a situation where the cash market has been firm, the box market has been firm, and futures are trading at a discount to where those cash markets are at right now. So we've been playing a little bit of catch up here. Heavyweight cattle are making up for a lower slaughter number, keeping the production number where it's at. But I think the producer market is taking these higher box beef values as confirmation that seasonal demand is strong, even with retail prices where they're at, and even with talk of inflation and consumer spending and all the macroeconomic worries that we hear touted in the marketplace.
And we did have CPI out today, and that seemed to be what helped fuel the rally in the stock market, with the S&P hitting some all-time highs. So what does this mean in terms of the dynamic of money flow now, especially when you look at the ag sector versus the equities?
Yeah, really good question. I'm not sure. I'm scratching my head a little bit on the market action, the equities, and the interest rates, and the consideration of the PPI number here, or this in the CPI data. Look, I mean, inflation heading towards 4% annualized rate, still a ways off of the Fed's target here. And the Fed, Chairman Powell even says, hey, I'm a little confused by what's going on. The market has seemed to ignore that and is expecting rate cuts and pricing in a vibrant economic, growth pattern. And that may be the case. If that is the case, hey, that's great for our markets, particularly for the beef and the livestock markets. But I think there'll be some bumps along the road here, Michelle. And we're looking at a situation where it just, money flow, as the grains in particular have been a factor of that money flow. As we've seen the inflation play come back into our markets, we've seen that money come into the commodity sector, but come in a way that, it's looked at oil and said oil has rallied and peaked. We've looked at other markets and found that they're peaking as well. And in doing so, the grains looked relatively attractive. How long that lasts and whether we're going to continue to catch that flow, if you will, I think is a really big question mark going forward. It's really notoriously hard to predict that as a marketer or a risk manager of, hey, I have crop to sell. So I'm glad when we see it, but you have to be a little bit cautious as to how long it may last.
All right. Well, thanks for joining us. It's always Dave Chatterton with Strategic Farm Marketing. That is Markets Now.